Welcome to the Deep Dive, where we take a big stack of information and really try to pull out the key nuggets of knowledge for you.
Yeah, cutting through the noise.
Exactly. And today, we're diving into something pretty fascinating, actually. It connects two huge worlds. You've got federal financial regulation, and then the super-dynamic world of cryptocurrency.
Worlds that don't always talk to each other easily.
Right. So our mission in this deep dive is to unpack a really recent, pretty significant announcement. It's about how your crypto holdings might, soon play a role when you're trying to get a mortgage.
Which is, for most people, the biggest financial decision they make.
Totally. So we'll look at the news itself, but also some, let's call them forward-thinking ideas about how crypto could maybe fundamentally reshape how we finance homes.
Yeah, we're looking at this specific announcement from a key federal regulator, but also combining that with discussions popping up in the crypto community.
Kind of gives you a glimpse of the future, maybe.
Potentially. It definitely shows how fast things are moving in this space.
Okay, so let's get into it. The big news first. June 25th, 2025 just happened. William Pulte, he's the director of the FHFA.
The Federal Housing Finance Agency.
Right. And for anyone not familiar, the FHFA, they oversee Fannie Mae and Freddie Mac. Huge players.
Absolutely crucial. And it's important to remember, Fannie and Freddie, they don't actually give you a mortgage directly, right?
No.
They're what are called GSEs, government-sponsored enterprises. They guarantee mortgages. And crucially, they buy up bundles of home loans on the secondary market.
Which means they basically set the rules.
Pretty much. What they're willing to buy dictates what lenders are willing or even able to offer borrowers like you. Their standards become the industry standard, effectively.
Yeah. And so Director Pulte, he used, social media?
Yeah, social media post.
To tell Fannie and Freddie, okay, you need to start considering crypto holdings when you're figuring out if a borrower has enough assets for a mortgage.
He actually said, let me find the exact quote. Here it is. Today is a historic day in the cryptocurrency industry and the mortgage industry, whereby Fannie Mae and Freddie Mac are now positioned to involve cryptocurrencies in mortgages.
Wow. Historic day. That's strong language.
It is. And if you think about the bigger picture, allowing crypto to count as an asset, well, it means borrowers who hold crypto might look stronger financially on paper.
So it could help them qualify? Maybe get a better rate even?
Potentially, yeah. Or just get approved at all. It could really increase their chances, especially for folks who are, asset-rich in digital currencies, but maybe lighter on traditional cash savings.
Okay, so what are the specifics here? Did the order lay out exactly how this works?
Not really, and that's key. It tells Fannie and Freddie to develop proposals. So the how isn't defined yet.
Ah, okay. So work in progress.
Definitely. And crucially, it doesn't say which specific cryptocurrencies will count. That's a huge question mark.
Right. Bitcoin, Ether, stablecoins only. Big difference.
Huge difference. But it did specify one thing. The crypto assets have to be evidenced and stored on a U.S.-regulated centralized exchange subject to all applicable laws.
Okay, so not just any wallet or offshore exchange needs that U.S. regulatory wrapper.
Exactly. And maybe unsurprisingly, it also said Fannie and Freddie can factor in other risks like
volatility. Gotta be volatility.
You can go market volatility, how they'll measure that or discount for it.
Yeah.
Well, that's part of what those proposals will need to figure out.
Makes sense. So regulated exchange, volatility checks, anything else major?
Well, Pulte did frame it politically. He mentioned this fits into President Trump's vision of making the U.S. the, quote, crypto capital of the world.
Ah, okay. So there's a political dimension driving this as well.
Seems like it. A regulatory push aligned with a stated political goal.
All right. So the regulators are starting to move, asking for proposals. Now let's shift gears a bit. What's happening on the tech side in the crypto world itself that might actually, connect with this?
Good question. Because the tech often moves faster than the regulation. Our sources point towards companies like Metallicus and their products, MetalX, for example.
MetalX, I've heard of that. It's a DEX, right? A decentralized exchange.
That's right. Built on something called the XPR network. It lets users trade crypto, but also get into DeFi stuff.
Like lending and borrowing crypto.
Exactly. Lending, borrowing, staking, where you lock up crypto to earn rewards, yield farming, the whole DeFi suite, basically.
And it connects to MetalPay to get regular money in and out.
Yeah, MetalPay is their bridge for fiat, for dollars. And what's interesting about Metallicus, the company, is they really stress their focus on being compliant with U.S. rules.
Okay, so they're trying to build bridges to the traditional system, sounds like.
That seems to be the goal. And it's fascinating how these decentralized platforms are already doing things like lending and borrowing with crypto, things that banks normally do.
So it's not a huge leap to think about mortgages then.
Exactly. It feels like a natural extension, doesn't it? If you can already borrow against crypto for other things, why not eventually for a home?
And speaking of that, the sources mentioned something specific for Metallicus, the loan protocol.
Right. Another piece of their ecosystem. It's a decentralized lending protocol, also on the XPR network. And people in their community are definitely seeing the connection to this FHFA news.
Like who?
Well, one community member, Mr. Crypto 2328, apparently feels this FHFA directive lines up perfectly with what the loan protocol is designed for.
Interesting. Are they actually working with mortgage companies yet?
Well, according to this Mr. Crypto 2328, the Metallicus CEO, Marshall Hayner, has already had talks with mortgage brokers. And MetalX, as we said, already allows crypto lending and borrowing.
So the plumbing is kind of there.
The pieces are there or being built. Maybe not a direct mortgage product yet, but the source mentioned deep conversations about this topic and utilizing the loan protocol. So it sounds like they're actively exploring it.
Okay, so far, this is all about crypto being an asset you hold, something that helps you qualify for a traditional-ish mortgage.
Right. Using it to show you have reserves, basically.
But then
Right.
the conversation takes a turn.
Right.
There's a much more provocative idea floating around.
Oh, yeah. This is where it gets really interesting and, frankly, much more radical. It goes beyond just using crypto to qualify.
What's the idea?
It comes from another community member, apparently also a mortgage broker, using the name Grumpy Bear.
Yeah. Okay. Grumpy Bear, the mortgage broker.
Right. And their idea is, what if crypto wasn't just an asset on your application? What if it was the collateral for the mortgage itself?
Whoa. Instead of the house being the collateral.
Exactly. The proposal is for a whole new type of mortgage product where a specific crypto token, called LOAN in this concept, would be the main collateral. The property and the LOAN token would be linked somehow.
But the bank security is primarily the crypto.
That's the concept. Instead of having a lien on your house, they'd effectively have a lien on your LOAN tokens.
Okay, my head's spinning a little. How would that even work? Why would a bank do that?
Well, here's the kicker, according to Grumpy Bear. The bank could get regular payments automatically by staking the LOAN collateral.
Staking. Like earning rewards on the crypto?
Yeah. The idea is the staking rewards generated by the LOAN held as collateral could potentially cover the mortgage payments, or at least significantly contribute to them.
Wait, so the mortgage could sort of pay itself off just from the crypto rewards?
That's the really wild part of the proposal. If the clients start in the home long enough, the staking yields could potentially pay down the principal, and eventually the home becomes debt-free without traditional payments from the homeowner's income.
That sounds almost too good to be true.
It's definitely a radical concept. The proposal does mention standard stuff like KYC checks.
Know your customer. Standard bank stuff.
Right. And checking income and assets against the amount of LOAN needed. The LOAN would be tokenized to the property, basically locked up and taken out of circulation while the loan is active.
And when it's paid off, the lien is removed, the loan ends is released.
Exactly. And Grumpy Bear even suggests the staking could cover insurance and property taxes too, making it, in their words, potentially risk-free for the bank on their loan tokenized real estate portfolio.
Risk-free feels like a stretch for anything involving crypto volatility, but okay. Is there an example of how the numbers might work?
Yeah, a hypothetical was given. Imagine a house needing, say, a $1 million loan. Maybe you earn 100 LOANs per day from staking that amount.
Okay.
And let's say your monthly housing costs mortgage, principal, interest, taxes, insurance total, $800.
Yeah.
If LOAN happens to be worth $1 at that time,
You'd be earning 100 tokens times, say, 30 days. That's $3,000 a month in loan value from staking.
right. So you cover the $800 payment easily, and you actually net $2,200 a month in loan and value just for living there.
Okay. That is a provocative idea. Your house pays you.
That's the pitch. And the argument Grumpy Bear makes is that this kind of product would create, quote, extreme demand compared to traditional debt.
Yeah, you can see why.
The comparison is framed as, would you rather take out a normal mortgage, paying mostly interest up front, or have a house that literally pays you to live in it?
Puts it pretty starkly.
It does. And the suggestion is that homes tied to this loan system would be super desirable, and you'd only get these loans through specific banks participating in something called the Metallicus TDBM.
The digital banking network. Is that another Metallicus thing?
Apparently part of their broader infrastructure plan. And then comes the really big claim, speculating that this model could destroy the entire legacy banking system as their products will no longer be in demand.
Okay, wow, that's ambitious. Destroying legacy banking is a common crypto rallying cry, but
It's definitely a maximalist take, yeah.
yeah,
Highlights the revolutionary potential some people see, but obviously disrupting the entire global banking system, that's a monumental task with enormous hurdles.
understatement of the year.
But the idea itself, even if the destroy banking part is hyperbole, is interesting. Grumpy Bear also talks about banks or credit unions holding loan in treasury.
Like reserves.
Yeah, holding it on their balance sheet as collateral. They could then use that to back mortgages, offer other banking products, maybe hedge their risk, and even pass some yield back to the customer.
So the bank benefits, the customer benefits.
That's the vision. And if the staking yield generated more than the required mortgage payment, the extra could automatically go towards paying down the principal faster.
Reducing default risk even further.
Right, until the loan pays itself off and the loan goes back into the bank's treasury, ready for the next loan. It's kind of a closed-loop system idea.
And they mentioned over-collateralization.
Yeah, having more loan value locked up than the actual home value to cover things like potential repairs, insurance gaps, or, market dips in the loan price itself.
Building in a buffer for that volatility.
Trying to address the risk, yeah. It's a really fleshed out, though highly speculative, alternative vision.
Absolutely. So we've gone on quite a journey here. Started with a concrete step from a federal regulator.
FHFA saying, okay, let's figure out how to count crypto as an asset for mortgage qualification.
Then looked at the tech, like Metallicus building bridges.
Platforms like MetalX and the Loan Protocol potentially enabling new kinds of crypto finance integration.
And ended up with this really radical, community-driven idea of crypto, specifically Lonan, being the actual collateral for a self-paying mortgage.
Yeah, from crypto being just one asset, helping you get a traditional loan, to crypto potentially being the foundation of a completely new kind of loan, it's a huge conceptual leap.
It really is. When you look at all that, what strikes you most? Is it the immediate regulatory baby step or this wilder future vision?
That's a tough one. The regulatory step is real. It's happening now, even if the details are fuzzy. That has immediate implications.
True.
But the Grumpy Bear idea, while speculative, it really makes you think differently about debt and ownership. It challenges the fundamentals.
It really does. This deep dive, it feels like it's uncovered more than just a policy tweak. It's hinting at a potential paradigm shift, maybe, in how we even think about owning a home and building wealth.
A fundamental rethinking of assets, debt, and risk.
So as we wrap up, here's something to chew on. If we start heading down this road, maybe starting with crypto's assets, but perhaps evolving towards these more integrated models, what do you think are the biggest upsides? And maybe, what are the hidden